I am sitting here looking at the numbers, and it is remarkably clear that most people are walking straight into a financial buzzsaw while checking their social media feeds. Most people think investing $1,000 does not really matter, as if $1,000 is too small to change anything. But that exact belief is why most people never actually build real wealth, because they never even get started. But the first $1,000, it is not about getting rich overnight. It is about setting the trajectory for every single dollar that you are going to invest after it. And if you invest this wrong, you could stay stuck because you might be investing into the wrong things that you think are the right things, and you could just be building bad investing habits. So you definitely want to avoid that. But if you invest it right, it can compound into something way bigger than you can ever imagine, especially if you start out in your 20s. So if you had $1,000 to invest right now, what would you put it into? Go ahead and drop a comment down below. Now, before I even talk about investing the $1,000, I do have to set a couple of ground rules. The first thing that we are going to assume is that you already have an emergency fund built. So you already have a cash pile somewhere that is at least 3 to 6 months of your expenses. I also want to assume that you have no high-interest credit card debt. You are paying off your credit cards. You are not sitting there with $10,000 plus $1,000 of credit card debt, because you have to focus on these two things first before you even start considering investing, because no investment is going to beat out a 20 or 30% credit card interest rate. At the end of the day, you want to get rid of that as soon as possible, and the next assumption we are going to make is that this money is going to stay invested for at least 5 to 10 years. But if you know anything about compound interest, you know that the longer you invest, the more that your money will build up on itself, kind of like when a snowball rolls down a hill. So the goal of the first $1,000, it is not to get rich quick. It is to build investing habits that you can consistently follow over a long period of time. And while building these habits, you are actually going to see how markets behave. You are going to see what it looks like when you put money in and it goes up, or after your money grows for a little while. Maybe it drops a little bit, or maybe it drops a lot, and how do you handle that? And so a lot of beginners make the mistake of just treating $1,000 like it is a lottery ticket instead of an actual foundation to build real wealth. So what should you invest $1,000 into when you are starting out and you do not even have to invest $1,000 at one time? Maybe you just invest $100 a week for 10 weeks, or maybe you just invest $100 a month for 10 months. Now, I am not a financial advisor. This is not professional financial advice. But I think one of the easiest things you can do to start out is just to throw your money into an ETF. Something like VOO, which is just Vanguard's S&P 500 ETF, or VTI, which is just a total market ETF. These investments can be very boring, but that is a good thing, and they have very good historical performances over a long period of time. When you invest in an ETF, you are essentially just buying a basket of stocks. Now, I promise you guys, this is not going to be your stereotypical, oh, save up $1,000, live within your means, throw it all into ETFs. We are going to talk a little bit more about the $1,000 and why it is so important, but I definitely think a good starting option is to just invest into VO or VTI. Put all your money there, and you are definitely going to beat out a lot of people that are trying to pick stocks. You are going to beat out the day traders, and you are going to beat out all the different hot stocks that people want to put their money into. The $1,000 will compound when you start to add money consistently and you do not touch it. That is where you are going to see most of the growth, and that is where you should start, and most people do not even want to start there. So that is option 1, is you could just put your money into VO or VTI. Option 2 is that you could do more of a split strategy, where let us say you have the $1,000. You could put $700 into the S&P 500 or into VTI, and you could put the other $300 into a more growth-focused ETF. Maybe something like QQQM, which is more tech-focused, or VUG. And by doing this, you would be a lot more focused on more growth-oriented companies. And we actually have been seeing a little bit of a dip with a lot of these growth companies, so it could be a good time to get in, especially long-term. And when you have a smaller allocation towards some of these growth ETFs, it might keep you engaged. It can prevent you from selling if you get super bored, because that is actually something people do a lot more than you would realize. And the main rule for this smaller portion of your portfolio is you do not want to be day trading. You do not want meme stocks. Do not go buy a bunch of leverage things or try to buy options or trade options. You just want it to be a little bit more aggressive. Maybe, like I said, you could do 70% VU and then 30% with a growth ETF, or you could do 80% VTI and 20% with a growth ETF. But I do think that these two options are really good. You could just go all VTI if you want. Just try to break it up however you see fit. And your number one priority, especially when you are younger, is to invest in growth and not just comfort. Because your biggest asset when you are younger is time, there is a huge difference between somebody that starts investing at age 20 and invests $500 a month compared to somebody that starts at age 30. And the longer the time frame and the more money that you have into growing assets that are very consistent over long periods of time, it is going to give you a completely unfair advantage. And what a lot of people do not realize is sometimes when you are playing it safe with $1,000, it is actually risky. Like if you do not want to do anything with $1,000 and you just leave it in cash, then inflation is just going to be sitting there eating away at it. Your $1 that you have today, it is going to be worth less than $1 a year from now. That is the entire concept of inflation. Everything goes up and is more expensive year in and year out. And anyone who has lived on their own the past 3, 4, 5 years, you definitely have noticed this. And so the opportunity cost of holding $1,000 just on the sidelines is actually pretty high. A lot of people do not realize that, because at this stage in your life, you need upside. That is one of the most important things. The thing you have to realize is that $1,000 today could be worth $20,000 or $30,000 a couple of decades from now. So it is not just money today. It is total leverage, and it is going to give you a huge advantage if you can invest it well. $1,000, it is not going to make you rich overnight, but it will change the way you think, because after you start investing, your money is going to feel exposed. Like you actually have skin in the game. Now you could actually lose money or you could make a lot of money. Like you are kind of putting yourself out there financially in a way. And the thing about investing $1,000 that will actually help you a lot is the psychology of it. Because for example, if somebody gets a huge cash amount, like an inheritance of $50,000 and they invest all of it, and let us say the market has a bad year and it drops 20%, somebody that is not comfortable seeing their money drop, they would have just seen their portfolio go from $50,000 to $40,000. They would have lost $10,000. And when you are not used to the psychology of seeing your money go down, it is very hard, it is very stressful, and that is where most people panic and sell. But when you slowly invest consistently over time and you eventually get to that $1,000 mark, you are going to be a lot more accustomed to the market swings. Like for example, the past week or two, the market has been dropping. I do not give a shit. I have been investing for about 5.5 years now. I do not stress when the market drops because I do view it as an opportunity to be buying really high quality assets on a discount. And that mindset is going to get you really far, especially if you can learn that early on. Because the moment that your money is invested, you are going to stop thinking like a consumer and you are actually going to start thinking like an owner. Like you actually own an asset that is going to grow over time. This is a really valuable thing, and having that ownership and really being able to take control and shape your future, it is going to give you a sense of responsibility. And responsibility hopefully creates better decision making. This is why I feel like the first $1,000 is a lot harder than the next 9,000, because wealth does not start out with returns. I mean, if you invest $1,000 and you get 10% the first year, that is great. You made $100. But real wealth is built when you start out by participating and you actually get some skin in the game. Quit sitting on the sidelines and waiting for the market to drop. At the end of the day, you could wait 2 or 3 years. And by the time the market drops, it only drops back to 6 months ago prices. It is not going to drop back to 2 or 3 years ago. And even if it does, that is a really big discount that you should be buying the dip on. Because people who never invest their money, they are always just going to be spectators. They always have some excuse as to why they are not putting their money in. And when you invest that $1,000, it forces you into playing the game instead of just sitting there on the sidelines. The compounding of building wealth starts a lot more in behavior compared to the actual balance of your account. That is where the real wealth is built, is understanding the psychology of all this, and picking up the habits and sticking with them over a long period of time. You do not need to have $20,000 to start. You do not need $10,000. You could even start with $100 for 10 months. There you go, you are at $1,000. That is like pretty much $25 a week, assuming 4 weeks in most months. And like I said before, that first $1,000 that you invest, it teaches you how to actually handle risk and volatility. It is so easy for somebody that has never put a dollar into the market to sit there and go, oh yeah, this is a great time to buy the dip. Oh yeah, the market is just topped out right now, man. You want to sell and get out of there. It is so easy to say that when you have never taken any risk yourself, because you do not actually know your own risk tolerance until you start getting involved in seeing these different swings. And like I said before, with the $50,000 example versus the $1,000, obviously investing $50,000 would be nice starting out, but that is just not realistic for most people. And also, I do think the psychology of investing consistently and slowly building it up over time just makes you a lot more callous to the market swings, because that is going to happen. The market is going to drop suddenly, it could move against you, and it may make you even question yourself, like, oh, is the market going to go flat for the next 10 years? Are we going to tank and see a huge economic crash? And this is where people really start to learn about themselves. They are going to be asking themselves, do I panic sell? Do I hold? Do I keep trading? Like, what do I do? And it is much better to learn these lessons with $1,000 than 100,000. Because where most mistakes are made with investing is when people are emotional and they are not logical and they are not thinking long term. In that first drawdown, when the market is dropping, it will teach you patience, it will teach you discipline, and it will definitely teach you how to be convicted towards something. And what a lot of people need to know is that losses hurt way more psychologically than having big gains make you feel good. So what I mean by this is if you have $10,000 and that doubles,
Yeah.
that would feel amazing, right? But if you have $10,000 and it goes to 2,000, that hurts way more than the amazingness that you felt from your money going up. So if you can actually stay rational with $1,000, then you are training for much bigger numbers later. Like for me personally, my portfolio is between 145,000 and 150,000, kind of depending on the week right now. If the market were to drop 50% over the next year, I would not bat an eye. I would just keep buying. Like I really do not stress over these things because either I put money in and the market goes up, which is great, or I put money in, the market goes down. Awesome. I get to buy really high quality assets on a discount. And like I said before, this $1,000 you invest, it is going to teach you emotional control before the real wealth arrives. And the goal here is not to avoid loss. It is just learning to survive different uncertainty. Because you are going to see headlines every single week and every single month that are telling you why the US is going to shit, why VTI is a bad investment, why you need to get completely out of the US, or why you should own all these different stocks. But it really is simple, and the people that understand this do really well over a long period of time. Now, I am not saying do not diversify at all. Obviously, do whatever allocation you want with your money. But this is just truly how I feel. So whenever most people start, they tend to ask themselves, well, what should I buy? Or the better question is, why do I believe that this will work? And investing this money, it is going to force clarity because you cannot just hide behind diversification. Every choice matters a lot more, so you have to start to choose different philosophies. Do you want passive investing versus active investing? Do you want to invest in growth versus income? Or do you want to be super concentrated or somewhat diversified? So it really lets you figure out your risk tolerance and what is going to work for you long term. Your framework that you set up here is going to determine when you buy, when you hold, and when you sell. And if you have a really bad framework set up when you start investing, even if you just have a bunch of money, all you are doing is just scaling up a bunch of mistakes. Like you have to be really smart about this, because a good framework, it is going to keep you consistent. It is going to reduce emotional decisions. And like I said before, it is going to build a lot of confidence and a lot of conviction. And a lot of people will just copy assets without actually understanding strategy. Like I truly encourage you to go look up some of those ETFs I talked about and understand why have they done well, what are the risks I am taking if I own them for the next 10 or 20 years, what could possibly happen here. And if you do not actually know why you bought something, then you won't know when to hold it. You won't know whether you should sell it. At the end of the day, I am a very long-term investor. I do not sell my assets at all. I just keep investing super consistently. I hold during the downturns and I keep investing regardless of what the market is doing. I am never going to sell based on market swings. And $1,000 is going to expose this weak thinking very quickly if people tend to panic like that. And this is a really good feature. And with that first $1,000, you are going to learn pretty quickly what you are doing right and what you are doing wrong. And one thing I want to make very clear here is it is okay if your $1,000 you invest is not perfect. It is not meant to be because optimizing what works best for you. That is going to come after years of experience. I do not expect it to happen overnight or within a month or even a year. Then you should start to really figure out what works best for you. And constantly waiting for the perfect move. It is just going to delay your progress. Like I said before, get some skin in the game. Early investing should prioritize understanding what you are doing, keeping things very simple, and then being consistent. Because when things are really complex for anybody, it creates hesitation. Because think about it, when things are really complex, people tend to hesitate more. Like even if you go out to eat at a restaurant and there are 100 items on the menu, it is a lot harder to pick compared to a menu with 20 or 30 items. Like that psychology is just a consistent thing, whether we're talking about money or not. And when you keep things very simple with your investing, This will help you create momentum. And so what happens is a lot of people tend to stay in cash because they want validation, they want guarantees. They want to know that, hey, this money is safe, it is never going to go down. And like I said before, investing, it does not reward somebody being certain. It rewards the people that participate. A famous investor once said that the market in the short term is a judging machine, and in the long term, it is a weighing machine. Your first investment is not going to be your best one, and that is okay. It is supposed to evolve. And confidence comes from being repetitive and seeing progress. You do not have to just be perfect to start out. I mean, think about when is the last time you did something, and the very first time you did it, you were just perfect at it. I do not know about you guys, but I suck at most things that I do when I am starting out. So it takes time and it takes consistency, and you are not going to learn by watching on the sidelines. You can sit there and watch 100 YouTube videos about investing, but you need to get your money involved because you are going to learn way quicker by doing things. And small mistakes now are going to prevent a lot bigger mistakes later. And so like I said before, the goal is not to maximize returns. It is just to get started. Just at least get started in the process. Now, what I would not do with $1,000 I do want to talk about, because I would not trade options. Now, I understand that you want to turn $500 into $10,000 overnight by buying a call option on some random stock that you read about on Wall Street Bets. I understand that logic. That is how a lot of people think when they start out. But I am telling you right now, the options route is not the move. For most people, it is a very bad form of gambling, and you do not want to go down that rabbit hole. And I feel the exact same way about day trading. When is the last time that you have seen a day trader online that does not sell a course? I do not know about you guys, but I see that left, right, and center. And I still get ads for it, even though I do not day trade at all. And kind of the trap psychologically that people tend to fall into is that they just want to see a ton of excitement instead of results. And that is why when you are first investing, the slow compounding, it is going to feel invisible at first. You know what I mean? If you get a 2% return on a $1,000 portfolio, you are not really going to notice that, right? But then you are going to invest another couple $100. And before you know it, you are at 2,000, and then you are at 5,000, and then 20,000. And you are going to really start to see it pick up. So that 1 or 2% that you get in a single month, it is going to get bigger and bigger over time, which is awesome. And I even remember when I invested my first $1,000. I am pretty sure prior to that time, I had not saved up $1,000 a single time in my life. Or if I had, I would just go spend it until it went back down to 500 or 400. And once you actually invest that first $1,000, then the $5,000 feels a lot closer. I mean, hell, you are already 20% of the way there. And the $10,000 does not feel too far away either. And this is how, honestly, a lot of people build wealth. And like I said, I even remember when I hit that first $1,000, I think I was 21 years old. And I remember thinking to myself like, oh, that really did not take that long. In my mind, I thought it would take way longer than it actually did. And then right after I hit that, I remember thinking, oh, well, how long is it going to take for me to go to 2,000? And how can I save money and find different ways to invest more money so that this can hit my goals quicker and quicker? And it should hopefully motivate you to keep investing and to try to find different ways to invest more and more. So those are the best ways to invest $1,000 in 2022. I am telling you not to keep it on the sidelines. And again, I am not a financial advisor, but in my opinion, I just do not think that is the right move. Investing into assets that have appreciated and gone up in value over a long period of time. History repeats itself, you guys. It is going to continue to happen, and so I would just stick to that. And one question a lot of people have is what company or what website should I use? Should I use Robinhood or should I use Vanguard? I personally use M1 Finance. I have found that to be really well, and that is what works for me. Their style of investing is very simple. It is like a pie. So you could literally set up a pie, put your first $1,000 in. And what I mean by this is 80% of the pie could be in VTI and 20% could be in VUG, or it could be in VUO, the S&P 500, in a different ETF. And so they really do make it super simple. That is where I put most of my money into besides my 401k. So I did want to at least answer that question because people have been asking me a little bit more often. And the nice thing about M1 Finance is you can buy fractional shares. So make sure regardless of what website or what brokerage you go with, make sure that you can buy fractional shares because that is super important. If you cannot buy fractional shares, then the barrier to entry goes up a little bit and it could be a little bit frustrating. So that is it for me. I hope you guys enjoyed the video. If you did, drop a like down below, hit that subscribe button. I will see you in the next one. Peace.